Okay, says we're now live. Okay.
All right. I see. All right. Can folks on the chat maybe chat us up? Are you guys have we resolved some technical difficulties, or are we still having a problem? I see Bill Fazioli. Bill, do we are we good, or are we still having issues? Is there anyone on the chat want to give us some indication? Success. All right. So I see Jen Ludwig has chatted that we have success. So I think we can begin. Let's just get started. I hope that we don't encounter any more technical difficulties. I think what we're going through right now is obviously just, I guess, emblematic of everything that we've gone through over the last couple months. So I'll start by saying thank you. No, Frank, thank you for inviting S&P Global to participate in this panel. You know, obviously and we are very appreciative of the consideration offered by the Treasurer's Office, and certainly, you know, having you guys give us the opportunity to express our views of you know, the credit environment and what we're thinking. I mean, I'll get right to the presentation, and hopefully I won't eat it all up. Hopefully I'll save some time for our Moody's counterparts to join and share in their views. But I'll get right into it. So as Frank said, I've been with S&P for 15 plus years. I've covered municipal credit, you know, across the East Coast, focused a big chunk of my career looking at municipal credit in New England. I've done a lot in Rhode Island, and certainly I'm happy to be here again. This isn't the first time I've addressed the league. So where do I begin? I mean, 2020, what I would say is a year like no other. I mean, the extraordinary events of 2020 will certainly, I think, shape the decade ahead in a number of ways. And as the pandemic has continued to spread this year, I mean, the public finance issuers, you all, have had to navigate social, financial, and economic effects of this disease. So, I mean, as I said, I've been 15 plus years, and early in 2020, we did something unprecedented, I think, at S&P Global. We put our outlook for the whole sector on negative. Now, I don't want to confuse folks. We didn't put bond ratings, all of our bond ratings, on a negative outlook, but we put the whole sector, so state, local governments, our transportation infrastructure enterprises, our healthcare and our higher ed institutions, the whole sector we viewed, you know, being negative because of just the sudden stop recession and what that led to in terms of rating volatility and obviously revenue volatility. Now, you know, it was. I still remember back in March, and it was like I felt like I was living in a moment in time. What seemed like, you know, the progression of what was a record economic expansion ended abruptly, and it was replaced with a sharp decline in GDP, surging unemployment, and reduced consumer demand. Now, I mean, obviously, this created a lot of revenue and spending challenges across our rated universe, hence why we put it on negative outlook. And after 10 years of upgrades, for the first time in really a long time, that dynamic shifted abruptly in 2020. The majority of the rating actions that we've had so far have been negative outlooks, about 80%. And that's I think indicative of the times and the volatility that I think this pandemic has brought upon. Now, I mean, I do recognize, I think we all recognize that you know, the challenges associated with the pandemic have been actively managed in most governments. Over the course of the times of economic expansion, really did a really nice job, particularly in Rhode Island. I will say Rhode Island, following the Great Recession and the stresses that it was dealing with then, really did a lot in terms of improving its own financial management controls and discipline, and I think local governments followed suit. And as a result, reserves were built over time, and reserves. Leading governments basically entering into this financial situation or pandemic with a really strong reserves, and those have in many ways kind of lessened the credit pressure, at least in the near term. Moreover, I think despite the political brinksmanship and what is still a very much divided country, I mean, we can't deny that the federal action, that the federal government were swift and supportive. And certainly with the big $1 trillion stimulus plan early on the pandemic, and also with the Fed actions in terms of introducing the MLF program, certainly mitigated, I think, and stabilized in many ways the market, and really kind of helped stave off any significant deep pressure. Now, with that said, the pandemic and its aftermath will continue to dominate credit condition, I think, into 2021. And despite the vaccine, the virus curve is spiking, and there's still likely to be some potential economic damage ahead. So today, here we are. We do have more information. We have better information than maybe we did in the early onset of the pandemic, but our outlook still remains negative, especially given the pressures and the financial pressures that we see. We definitely do believe there's going to be more of a tail end to this than maybe what some economic forecasters were originally maybe thinking. In Rhode Island, we have not seen any rating downgrades in Rhode Island. And quite frankly, I think that, again, in many instances, governments were buffered by strong reserves and really took a lot of corrective actions, during the pandemic to kind of maintain costs and manage with potential revenue losses. With that said, though, I mean, the current environment is still weak and no one's out of the woods. Local governments, obviously, that have the weaker reserves and have been traditionally challenged with lower liquidity and cash flow, are going to remain acutely pressured, and that's without a doubt. And that's what we're expecting as we head into 2022. Now, if you see this slide, I mean, just I won't go bit by bit here, but these are just some local governments by the numbers, and what I will just point out is, again, just the degree of deterioration that happened seemingly overnight was profound. If you look at Q1 and Q2 of calendar year 2020, and these are numbers that are pulled from the St. Louis Fed, there was about a 17% drop in local tax revenues. A 17% drop in local tax revenues. And so that was, local governments are not that nimble where they can just handle easily in short order such a deterioration. And so it was certainly very challenging. The other thing I'll point out in this slide is that, for many ways, local governments, the way they deal with sudden volatility is, well, they'll pull back. They'll pull back investments. Which many of them did. They pulled back on capital spending and capex, and in the extreme situations, what they'll do is they'll cut services and cut employment. And so, and then this is meaningful because, if you cut employment and if you cut state local government employment, it's not going to be good for economic growth. If anything, it's going to continue to be a drag. And so that's something that I think is kind of the bind that many governments are in, and really that our economy is in. State and local government GDP is about 10% of overall GDP. So it's a big, significant chunk that I think is something that I think just, if anything, just complicates the choices that governments have. So what I'm going to talk about today, in maybe the next 15 to 20 minutes, and is what we're watching for 2021 nationally, and we'll talk briefly on what we're watching for Rhode Island local governments heading into 2021 and 2022. Now, obviously, stimulus is front and center. The stimulus, I think, that the Fed provided, or that the federal government provided early in the year, was certainly supportive of the economy, making sure that we didn't see that supportive in the economy in the sense that funds, supported paycheck and businesses. And obviously, it's supported by providing governments the CARES funding, which obviously helped and enabled them to manage COVID-related costs as best they can. But there were some restrictions in terms of the original stimulus funding for state local governments that were a bit restricting. And if you were to talk to a municipal manager, the strings attached were a little bit rigid and maybe not as flexible as maybe one would wanted it to be. Nevertheless, stimulus is important, and it has in many ways buffered a lot of state level deterioration. The other thing that we're obviously looking out for is the uneven health recovery, and obviously we're also looking at the state fiscal health. If you guys all recall, in the last Great Recession, the state of Rhode Island was very acutely challenged. Its economy was battered, and that had a significant effect on local governments. If you all remember, it was kind of a perfect scenario of state aid cuts coupled with severe declines in the equity markets, and local revenues really was in many ways what pushed a lot of governments over the brink to essentially fiscal crisis. Think of Central Falls. I know East Providence had some challenges, and there's Providence, of course, and there's many other examples. Now, so where I'm going with this is one of the questions, and the way I kind of designed this presentation was essentially focusing on the questions that we are asking ourselves within S&P and questions that matter. And obviously, one of the big things that we're focused on is how does the negative view of the state sector relate to local governments? Now, as I just said, while there is no direct correlation between a sector view on states and individual local government credits, we've all felt that the overall health of state finances can have a direct impact on locals. And after a period of remarkable stability in our state ratings, in 2020 there were 3 state downgrades and 14 negative outlook revisions. Now, as you can see on the slide, it just goes to show that the pandemic has had a very much strong impact on state revenues. This slide shows the percent change in state revenues from March, comparing March to September of 19 versus the same time period of when the pandemic began, March and September of 20. And as you can see, there were very few governments that were, impacted or not impacted at all. The vast majority, particularly in my neck of the woods, the Mid-Atlantic and the Northeast, saw some real considerable tax revenue declines, sometimes in upwards of 10% of their year-over-year 10% declines and 10% of the budgets. So now, we all know nearly all states are required to maintain balanced budgets, and so when when they're stressed, cuts are necessary to regain balance. And most oftentimes, those cuts come in the form of reduced state aid. Now, here's what I'll say. State of Rhode Island was acutely challenged in the last Great Recession. In this environment, we haven't seen quite the same acute pressures, and I think a lot of that is because of the reforms on the pensions and really on the financial management and the focus on controlling costs and investing has really kind of positioned Rhode Island in a much better place. With that said, it did take them 6 months to produce a budget. They finally did, enacted a $12.7 billion operating budget for 2021. And really the key highlights for me out of that budget was how they reacted and what would the ending outcome was for the locals, which is important, right? Local aid, did increase. The budget did provide $25 million of local aid resources from the CARES Act to assist municipalities addressing the pandemic. Motor vehicle excise tax phase out was for the most part restored. And, there were other signs such as the Distressed Communities Relief Fund, as an example, which was restored, which was, eliminating the governor's earlier proposal to cut the program. So, I think that the state, for the most part, is still challenged. Local governments may feel that impact, but at the end of the day, so far we haven't seen any real state aid loss to locals. All right, so my next slide. What do we think? Well, if you're a local government, being prepared for potential cuts is important. A lot of local governments, when we early on in the pandemic, we were discussing and having conversations with, they were reminded of years past, and a lot of them really went to the 2008, 2009, 2010 playbook in terms of budget formulation. So I think that's a positive. The other thing is school aid. Early in the pandemic, there were state aid cuts nationally for school districts, but we think that the December relief bill will be positive in making sure that those cuts are not deep heading in 2021 and 2022. Many states are receiving much more in terms of funding from the December relief package for K through 12. Upwards of 4 times more money than they got in the original round of stimulus. And I think that that's a positive. Rhode Island is a sweep state, so depending on how they manage those funds, I think that my gut tells me that how they manage those funds will be in such a manner where they will try to avoid at all costs local cuts down. So the other thing that we're looking at, another question that we're asking, is what does this uneven health recovery mean, and how is it going to weigh on credit? Now, we did throughout the pandemic, one thing was very evident, right? That the virus affected the U.S. unevenly, from illness spikes to tax revenues to consumer behavior. And as we move through the virus's winter surge, we expect that the impact will be uneven further. Well, it will remain uneven. Now, how will this shape, I think, our view of 2021? Well, states and regional recovery readiness varies. We all know the logistical nightmare and logistical problems that I think our country is facing with the vaccine. And I think that is something that I think will be different state to state. So some parts of the country may be ready to move forward post-virus quickly, growing revenues quicker, expanding their local economy, while other states, it may take longer. Now, I will say this, with Rhode Island, the economic prospects have, over the last decade or so, the economic growth has been centered, if you will. I wouldn't say centered, but I would say in part built on growth in leisure, hospitality, commercial, retail sectors, and obviously they have been the hardest hit in the pandemic. And so, as an example, when you talk about unemployment, there's still about 15,000 jobs, I think, that remain lost in the sector in Rhode Island since February. So, and as you can see on the screen, the unemployment rates, vary from state to state. I tend to think that the more rural you are, the less impacted you were from an unemployment standpoint. Obviously, the more urban, concentrated economies or packed economies are the ones that are being impacted the most. Excuse me. Now, my next slide, one of the things that we're obviously going to continue to evaluate and does play directly into a bond rating is your unemployment rate. And as we talk about the pace and the uneven pace of recovery, well, this is what the historical unemployment rate looked like going back to 2006. And you can see it's always tracked above the US level. But one of the things that I'll highlight here was following the Great Recession, it was slow to recover. It was very slow to recover. There were 4 consecutive years where unemployment, at least in Providence County and even in Rhode Island, hovered above 10%, which is a number that we consider to be high and elevated. I mean, you contrast that with the neighbors to the north and or other parts of the country. I mean, you can see that there's certainly something to be said. Hey Blake, welcome, my friend. I'm loving this. So I mean, moving on. So I mean, moving on. What do we think? So I mean, I think
It was you.
Hey Blake, do you mind going on mute, bud? There you go. Perfect, thanks. So what do we think? I mean, will an uneven health recovery weigh on credit quality? Yeah, we do think it will. It will be felt different from state to state, also different from county to county, region to region. The other thing we do know is throughout the pandemic, property taxes have actually been held been very resilient, even despite all of the delays or the potential or the relief packages to taxpayers, offering them to defer their pensions. Collections for the most part held at close to prior levels. So that I thought that was a positive. And obviously for Rhode Island, that's very important, because that's for many governments, a very, very large part of their revenue base or revenue source. We also learned that in the event of a lockdown, sales taxes may not dip as much as feared. And early on in the pandemic in March, I had no idea what the impact of the stay-at-home orders was going to translate to in terms of revenue loss, especially for sensitive, big broad sales tax revenues. And I think we've gotten a lot more information, and I think what we've learned is that people will go online, will just spend online, and consumer behavior will, while it did dip, it didn't translate, or it didn't dip to such a degree that it translated to a severe drop off on sales taxes. But of course, that is very much very much uneven. The impact still is different from state to state. Sales tax activity in New York is obviously still pretty below average comparatively speaking, vis-a-vis sales tax activity from the state of Georgia, which has been for the most part less restrictive in terms of their economy stop and starting. I'm just mindful of time because I want to give Blake and Nick an opportunity on stage. So I'll quickly touch on ESG, but I know Blake and Nick have a lot to talk about with ESG, so I'll give them the opportunity to really expand on that. But for the most part, I mean, ESG conversations are only going to ramp up. And the question, I guess, that a lot is in the front and center of a lot of folks' mind is, will ESG issues remain an important challenge that affects credit quality? And the answer is yeah. After many years, the ESG conversation has always focused on the environmental risks, if you will. But in 2020, I mean, with the pandemic and with all of the with the pandemic and the public safety and measures, and also with the civil unrest that we saw early on in the summer of 2020, the social and the ESG has become more prevalent, and obviously the G, the way I always look at it is the G is really there to manage the environmental risks and the social risks. And so the G, it was tremendously pressured, or the governance of it all. Now, here's what I'll say, about ESG. Will the conversations ramp up between us and local governments? The answer is yes. It's going to become more and more prevalent in our rating meetings, and especially as we get better data. Our data is that we are receiving on these subjects, and looking at environmental risks and wildfires and climate change is getting better and better each year, and through that we're going to be able to synthesize the relative impact to credit in a much more robust manner. So more to come. With that said, though, I mean, environmental concerns in Rhode Island is a big thing. Cyber security is obviously something that is should be in the mind and the forefront of local governments, with phishing and et cetera, and so yeah. But I'll leave the rest of the ESG conversation to Nick and Blake, because I'm sure they have a lot to say about it as well. So moving on, I did want to spend maybe just a couple seconds just talking about what the impact, I think, is, or the outlook is to Rhode Island credit specifically. We'll spend just a few minutes on this, but in doing so, I just want to remind everyone what are some of the key elements that go into a general obligation credit analysis. Obviously, the economy, management, finances, and debt and liabilities are important factors, and so is the institutional framework. The institutional framework, for those who don't know, is our measure of how the local governments or how the state government play, or with the local governments. And what I will say is, so far, state of Rhode Island has been fairly predictable in its revenue and expenditure disbursements, and they've been highly supportive in terms of providing the tools for those governments that are more challenged or distressed to course correct, if you will. If you guys all remember, many years ago, there was a tremendous effort to provide a form of support for distressed communities following the bankruptcy of Central Falls. Now, real quick, local government ratings distribution. The vast majority of our ratings in Rhode Island remained high investment grade, hovered around the AA mark. I think supporting that has always been the incomes, the fact that for the most part, Rhode Island does have networks to broad, diverse economies. And also because, for the most part, governments in the state have done a really good job bolstering their reserves and maintaining their reserves, recognizing that, that they don't want to be in a position where they lack flexibility, especially when things go sour. I'm going to share this presentation with the group. I won't, but there's just some statistics here that I think could be useful to know. Now, what are we watching in Rhode Island? I mean, the economy, I think, is clearly something that I think is a challenge. The demographics continue to constrain the growth, and this isn't unique to Rhode Island. This is, for the most part, across all of the Northeast, and so it's hard to say what a recovery is going to look like, right? The other thing that we're being mindful of is if you will, well, let me take a step back. Getting back to the demographics, I mean, forecasters and are now starting to, for the most part, starting to look at population. And unfortunately, I mean, owing to a series of events and the developments that have happened over the course of the past decade, from the global financial crisis to the opioid crisis that many communities are grappling with, from restrictive immigration policies of the last administration and to the COVID pandemic, a lot of forecasters are starting to think that population estimates going forward are maybe a little bit too rich. Specifically, assumed death rates have been too low, anticipated birth rates have been too high, and expected immigration rates have been too high. So what does that all mean? It means that a lot of forecasters now looking out and estimating that population projections for 2020, 2030 are likely to be 2% lower than in previous projections. And for states like Rhode Island and moreover the New England, I mean that is going to, I think, be something that we're going to continue to monitor, because it is fundamental, and it is something that over time will play itself out in various ways. Financially, property taxes remain the biggest revenue source, and so I think that that's a positive. With that said, though, another positive has been management's actions to make sure that they're controlling spending, that they're making the budget modifications necessary to make do with less local revenues, if you will, or non-property tax revenues. But I mean, again, I think margins have always been tight in Rhode Island, and so if anything, there's going to be continued tightness, and we could see some potential stress, materialize over time, because inevitably, costs do grow, and the ability to raise revenues, both due to revenue limitations and or just due to political will be pretty difficult. And so we should expect to see margins tightening. And debt and liabilities, I mean, there are opportunities there. Most governments have deferred capital, which is only going to potentially mean a ramp up in future debt, which is something that we're monitoring. Now, as we are in a period of low interest, and for those governments who have that opportunity, I mean, there is opportunity to the cost of capital is fairly cheap still, and that could provide some budgetary flexibility. The other thing, and this is a little bit more bespoke, and it'll be it before I kick it over to the team. Pensions and OPEB. State of Rhode Island has done a lot on pensions and OPEB. Now, one of the things that I think we're paying attention to is those governments that have no choice but to start to reduce payrolls or to cut staff. That actually might exacerbate the pension OPEB challenge, because what that means is that there will be less employees paying into the system, and depending on where your payroll growth rates are, that actually might mean that more tax dollars need to backfill. So that is something on the liability, on the balance sheet, that we're paying attention to, that might closely connect to the economic picture that we're also paying attention to. So I mean, with that, I'm gonna pause. I've eaten up way too much of everyone's time. Blake, are you on? Can you say something?
Yeah, thanks, Vic.
Yeah.
Sorry for the delay. Speaking of, and I think Nick might be on as well here. Speaking of cybersecurity, apparently Moody's has exceptional cybersecurity, and we were unable to log in because of our firewall. I actually I can't even use my work computer. I had to pull out my personal computer, and we had to redo everything from the back end with Jen. So Jen, thank you for all your hustle on the back side of this. It's really appreciated. On that note, Nick, I'm going to just kick it over to you for, I know you had some opening comments, and I know we have limited time, so we might just jump straight to questions after a few notes, but go ahead, Nick.
Sure. Can you guys hear me?
Yeah.
Yes.
Okay, thanks. Are you able to see our presentation?
Well, not yet. That I stopped sharing, so I think you should be able to do it now, right?
Let's see if Jennifer's able to share that or not. But regardless, given the technical difficulties, we'll share our presentation. I think it will walk you through kind of.
At least. Sorry, guys. I shared it in the chat for everyone, and I'm going to try to open my screen now with it.
Okay, great. So, similar to the overview that Vic gave. The Moody's outlook is negative as well for local governments and most of public finance. I think getting down to kind of the heart of the matter for Rhode Island, some credit trends that we're going to be focused on over the next couple of years are tax-based trends and property tax revenue trends. And what we'll be looking at is commercial real estate prices. Most of those commercial real estate sectors prices have started to decline in 2020, except for maybe multifamily housing and the industrial sector. So we'll start to see how the direction that those prices go. Will it be as severe as the Great Recession, or will it be more moderate? And how long will those trends continue? And then even more specifically, with the change to kind of with how we work day to day and the work from home expansion is office leases, and what office leases will mean for larger cities and towns that have some commercial presence. The good news there, and what you'll see in our presentation, is that lease terms for commercial space and office space is generally pretty long term. The average lease term is about 9 years. And if you look at larger square footage, so 100,000 square feet or more for larger businesses in their footprint, the lease terms are around 12 years. So there's a lot of runway to see what kind of trends stick coming out of the pandemic, and will work from home be a big component of the economy going forward, or will it subside a little bit? And we'll see. And so there's time. We expect that there will be changes to the economy and to the overall tax base composition to some extent, but we don't foresee any kind of significant cliff in the near term that all of a sudden property values or economies are just going to, at least as far as real estate goes, just take a huge nosedive. It's going to be, it'll be a long-term trend that hopefully will buy municipalities time to adjust to. The other significant factor that I think Vic touched on was job loss. Job loss was, especially for the lower wage tier, has been very significant, and especially in the Northeast, where I think Rhode Island, Massachusetts, Vermont, New Hampshire have seen some of the largest unemployment rates over the last year. And so that's something to monitor and see how, again, that will probably be more of a long-term credit impact, but it's certainly going to be an impact. Those jobs, some economists say that those jobs are going to take a whole decade to recover from, and a lot of them won't come back. So how that impacts the overall economy is something that we'll monitor as well. So those are just a few things that we're focused on from a kind of turbulent times type of factors that we think over the next 3 to 5 years plays some kind of role in credit quality over the long term. And with that, I'll turn it over to Blake to highlight some other key topics and try to leave some time for questions. Thank you.
Blake, I think you're on mute.
Thanks, Nick, and thank you to the Rhode Island League of Towns and Cities for organizing this, and sorry once again for the delay and sort of getting us up and running here. And I'll try to keep my comments relatively short. I'm going to touch on two specific areas. One is, turbulent times as it relates to bond ratings, and then I'm going to get briefly into ESG factors as Vic had mentioned earlier. And just on sort of on the point of bond ratings and specifically Rhode Island, I'm not going to talk about national trends. I might touch on some regional pieces here real quick, and that is really, I think, the rating agencies, Moody's, in my reference point here, really we're looking through cycles, we're looking through some of the event risk, and we're looking at longer term trends, right? And I think it's important to keep that in mind. And two specific points I'm going to come back to over the next few minutes a couple of times is what levers do you have to pull, and what's the story you're trying to tell us? And I think those are two things that, whether it's normal times or in this context of turbulent times, are to keep in mind. And so just to sort of go right sort of at a couple of things here, the framework, which quite frankly, both rating agencies are looking at, is this, is that 60% of your rating by methodology is driven by wealth metrics, call it full value, call it MFI, call it per capita value, and full values. And that's about 30%, and another 30% is driven by fund balance type of ratios to revenues or cash reserves. Again, things that just sort of talking about that first 30%, and Nick was just touching on it, and Vic was touching on it earlier. We're not going to really move. I don't think it's very challenging for a city or a town to move the needle relative to impacting their rating, talking about wealth metrics and demographics and property values. Maybe there's a little bit here and there, but the Northeast, Rhode Island is built out, and you're not going to see, I mean, should you not be doing economic development? No, I'm not saying that. You continue to do that. You continue to push forward on those items because that's what helps and drives the local economy, but it's not going to move big rating actions. So that's not a really strong lever. The lever that you guys have to control really is that finance, that fund balance issues, those reserves, contingency reserves, especially in a time like this. And given your tax cap where you can push things up 4%, that gives you your flexibility in there, where I think we as rating analysts are going to look through some of the challenges and some of the dips in fund balance, or even some of the spikes in growth if you're building fund balance for capital projects, that provide us sort of context for rating shifts, rating stability, if you will. And I mentioned that lever, but I also mentioned the other lever of a story. And I think it's particularly important, especially in turbulent times, to make sure you're forecasting to the rating agencies on an ongoing basis, and during our calls, what your local government strategy is and how that is reflected in fund balance ratios. Where do you have contingencies? Where are you building your capital reserves for projects? And I think those are like key elements that really help us shape what we're doing. Because if you remember, and all of we take all this information in, we take our conversations in, and we go to a committee, and we're sharing that story, and we're sharing our perceptions of that story with the committee, and that's driving the rating. And we get that fund balance will dip, especially in times like this. The question is, was that, how have they responded to that, and what are they doing to either build those back up or stabilize those fund balances? Where do they have other contingencies that they can draw from? And so I'm not going to spend too much more time on that, other than that those are key components that I think everyone should be very mindful of, and making sure they frame that correctly for us. And I know, I've worked with a number of people in Rhode Island, and they've done just a wonderful job in sort of sharing how, whether it's East Providence, whether it's Providence, whether it's Westerly, and other communities I've worked with that share that context of how those things are shifting and changing and what the community is doing. And I think that is critical to maintaining and strengthening a rating. So the other two pieces of that puzzle really are, we've talked about debt and we've talked about management, and both of those are 20% in a sense. Debt, again, you can move debt, you can, and you can delay projects, but we also get that, there's probably few communities out there that can sort of say, yeah, we want a new police station, so we're going to build one. No, if you need a new police station, you got to do it. Maybe you can put it off for a few years, but we get that debt is going to happen. So you have a little bit of a lever there, but we get that's not much. And management is something that in many ways is a function of policies at a state government for Moody's, and we call it an institutional score, and those are drivers. So really you're looking at pieces of your debt, and again, that fund balance ratios are going to drive things going through the future. And so particularly in times like this, it's going to be critical to sort of focus on those areas. And with the communities I've worked with, where you're doing a great job of that. And just sort of to touch on a couple other items here, I'm going to talk about ESG briefly. Obviously things have shifted over the last 12 months, where the emphasis, has been on the environment, and I want to come back to that in a moment, and it's now shifted towards, social issues relative to the coronavirus. And, just so you know, again, I'm not going to talk about sort of the bigger picture of this, but what is Moody's doing on the rating side that could impact you, that you need to be aware of? And again, this goes back to shaping a story that shows what you're doing is critical to this process. One of the things that we did last spring is we looked at all the municipalities, all the local governments that we rate across the whole country. And we looked at them through a social lens of demographics relative to age, economy relative to exposure to tourism, exposure to certain industries, and these types of things. And there was a number of brackets we went through, and we gave bands for those. And what we did was and in those bands, we looked at things that were, didn't seem to be an issue, areas that had modest issues, but didn't really require us to take another look at. And then we had a band of issuers across the country that every single analyst at Moody's had to knuckle down and call these issuers. And a number of you are in this group where I made calls to Rhode Island to find out how you guys were managing through this. And you're going to see that more and more again. And I'm assuming, S&P and other rating agencies are doing similar types of filtering and process. And this gets back to what both Vic and Nick were saying in terms of, more energy is being spent here, and you're going to see this coming back again and again. Are we seeing major rating changes because of this? No, not yet. I think people are still figuring out how this all plays out, but the data is out there, and that the analysts that are coming to you, giving you ratings, me, in Rhode Island, and other analysts that come to Rhode Island are going to be looking at these numbers and asking how you're managing through these, and what the story is behind this, and how this might impact your local area. And I think that's sort of where you're seeing the lens in terms of social issues focus. And, from that perspective, if anybody wants it, we've written a couple papers on social considerations in municipalities and credit challenges. And really what we're looking at is we're focusing on about 6 areas, and those are demographics, we're focusing on labor, income, education, housing, health and safety issues, and access to basic services. So, we're going to be talking more about affordable housing, income inequality, and how that can impact a municipality's tax base and local economy over a long period of time. And again, those are sort of major issues that were in the background still, but something that is beginning moving to the front burner for a lot of rating analysts on wherever rating agency you're from. So I think, having, again, through your strategic planning at the municipality, addressing those issues and understanding how that fits into the context of what you're trying to do financially, economically, and for the welfare of your citizens is going to be critical. And then the last one that I'll touch on the last couple I'm going to touch on briefly are the environment. I was lucky enough to work on a paper at Moody's looking at, the impact of sea level rise on municipalities. And so I've become a little bit more up to speed on these items, and, talking to cities and towns in Rhode Island, again, you look at Providence, in some ways they're ahead of the curve, the 1966 Fox Point hurricane barrier is there and addressing it. I've talked to other communities that are on the coastline where they may not have a specific sea level rise plan, but what they're starting to do is use their CapEx spending to move utilities, to harden roads that are on the coastline. And again, these are really positive things that can drive part of that story. And so we're going to be asking about this. And unless you share with us how you're using those CapEx dollars and how you're bolstering some of these environmental challenges, and more inland as we're seeing more rainstorms and major flooding, you're seeing the resizing of culverts, freeing up land for open space for short-term flooding and infiltration into the ground. Those are all, I think, key components that, again, shape that story of how you're responding to these things that rating agencies are going to be looking at more and more often over time. And again, these can have negative credit implications, or they can be stabilizing and have positive credit implications. And it's that balance of how you're doing these projects plays out in the balance sheet versus the financial statements. And I think that's what we're going to be looking at, is are you finding that right balance as you move through these, again, go back to the turbulent times? I think the last item to really touch on here from my perspective, and again, I know Vic touched on this, but I just sort of couldn't put enough emphasis on it, and that is governance considerations. And I think the point here is that, you know, you have to have a strong governance model. And it goes back to a very simple conversation I had with someone a long time ago. I was like, you know, if you had a preference, would you have a strong government and a weak financials? And I'd rather have a strong governance structure that knows how to manage, you know, a tight budget, knows how to manage challenging construction problems, versus a weak governance model with strong metrics. Over the long term, that strong governance model is going to be critical to the stability and the strength. And you can build these fund balances, you can manage through these capital projects. But again, having some of the strong players that you do in many of your governments, and, you know, highlighting those strengths to us and their experience and what they've done, I think is critical to those ratings. And I think so that governance lever, again, I think is a huge lever that can never be sort of pulled enough in terms of our conversations with us at the rating agency side. And I know I threw a lot out there in a short amount of time, but I just sort of wanted to give you a perspective of, you know, as the state lead for Rhode Island, the areas that I'm asking questions about, the areas that I'm thinking about, and the areas that I'm getting asked about internally when I'm taking your ratings on review to committee, or we're talking about social issues, or we're talking about hurricanes, event risk, sea level rise, or extreme rainstorm items that we're looking at over time. And on that note, I know we're running out of time here, so I'll wrap it up there. And I know there's probably some questions out there, so I'll throw it on mute for now. Thank you very much.
Well, thank you, Blake and Nick. Welcome in retrospect. We're doing things a little backward today, but tremendously important and informative presentations by you and, of course, by Victor. Hopefully there'll be some questions generated, but to get you going, I have a question. I don't know to what extent people are keyed into this, but could you explain, I know recently the states of Massachusetts, Connecticut, and Rhode Island entered into a guidance regarding remote work and collection of income taxes. And I don't know whether that might impact certain communities in Rhode Island more than others, I would assume, but can you explain what that is and what impact you think it might have on some of the larger communities like Providence and Warwick?
I guess I'll start. I don't know, Blake, Nick, if you guys had any comments on this. So the issue is, and we actually did produce a bulletin about this subject that I'm happy to share. You know, as far as I think and I don't know if it's guidance as much as it's I think it's working through the courts, state of New Hampshire suing the state of Massachusetts for I guess revenues or income tax revenues because of, you know, people who live in New Hampshire, who work in Boston, and because of the whole stay at home, there are now obviously some things that they need to work through. It's going through the courts, Frank. I mean, I to be honest with you, haven't really heard much more than that. You know, what I'll say is, New Hampshire is suing Massachusetts. This could have implications, right? If the courts agree with New Hampshire, then really business hubs like Boston, like New York, like might actually get severely impacted. They might actually see some considerable income tax revenue loss, and so that's certainly something that we're monitoring. And it's not unique to just New Hampshire and Massachusetts. To my recollection, I think Pennsylvania, Ohio, similar situations where they're looking to extract some dollars, you know, from other states that you know, due to that due to the fact that, you know, telecommuting has really changed the dynamic of everything. if it goes the way of New Hampshire, I mean, I think how that benefits Rhode Island, I think Rhode Island could have a claim. I do know that a lot of people work in Rhode Island, live in Rhode Island, work in Massachusetts, commute to Boston, or in the past maybe have commuted to Boston where they're no longer doing that. So, I mean, it's something that I think would be more to the benefit of Rhode Island than it would be to the detriment if that ruling did come to pass in the favor of New Hampshire. I hope that answered the question. If not, I'd be happy to share some literature, because we did just put out a bulletin on this not so long ago, kind of weighing our views.
Yeah, that'd be great if you could share that. You can send that to me. I can just distribute it. Thank you.
Yeah.
Nick or Blake?
Just to add on to, likewise, we have a similar paper that we wrote recently along the same lines. I guess, that said, when I think about local governments, I'll give you my sort of, as I sit here in New Hampshire, paying my taxes in Massachusetts, I'll give you my perspective on this. The state of New York was sued by a professor a few years ago at Yeshiva University who lived in Connecticut over the same purpose, and New York won that lawsuit, and the Supreme Court of New York didn't even take it up. So I will think that Massachusetts is not going to give up any tax dollars. I mean, they're as voracious and as tough as New York in terms of collecting, any dollars that come through the state. And I think it's going to be a long day before Governor Sununu sees his piece of the Massachusetts tax pie come back to New Hampshire. And I don't think it's going to be any different for Rhode Island. That said, I don't see it impacting, quite frankly, local governments in a significant manner, one way or the other over the long term. But again, I think as Nick says, we'll see if, these court cases play out any more than, political gamesmanship as it happens between rival states from that perspective. And so we can share that paper with you as well.
Great. Thank you. Now, do we have Q&A from the attendees? Anybody?
I think there's a question from Bill. I see. Question is how long do you expect strong residential housing market to continue? That's a good question, Bill. I mean, I wish I had a crystal ball to tell you. I've actually been surprised, quite honestly, in hearing from anecdotal from communities about how the housing market has remained fairly strong, even despite the pandemic. I don't have a good answer for you, Bill. I mean, it's obviously something that we're looking and paying close attention to. Housing starts has seen some hit, but it hasn't really been a massive one. I think this goes a little bit with what again, it's housing. There's a lot that goes into that, right? There's a demand, supply, the financing. It's hard to say. The financial institutions, the banks seem to be operating in an okay way, so I don't see any constraints there. But I don't know. I don't have a good answer. Blake, I don't know. And Nick, how you guys?
I can at least weigh in a little bit on that. And Frank, just as a reference point, I'm not seeing any questions come up on my display, so I'm just sort of responding to what's going on the screen. Bill, I think that's a great question. I mean, what you saw in December was, Rhode Island medium home prices went up 14% in December. I don't, given sort of where things are going and, how the work environment's changing, I don't really see a slowdown in that over the longer term. I think that, or I should say over the medium term, maybe. I mean, I really think we're talking about a new normal of the way people are working. I mean, you have companies as large as, us at Moody's and across the country that are rethinking their, financial footprint. So I think the challenge is on the commercial side, probably to a certain extent, but from a residential side, which is largely, a large amount of most communities, I think you're going to continue to see strengthening housing prices. And I think that will lead to, again, stronger full value numbers or at least maintaining and stabilizing trends over the longer term. And net, I think that's a positive for credit ratings. It's definitely not a takeaway. Like I said earlier, I mean, are we going to see major shifts in credit ratings because the tide has come in on property values to a certain extent? I'm not betting on that, but I'd love to see something like that. I'd love to see those shifts, but I'm not expecting that at this point.
Blake, let me say something real quick. The notion, I think, and this is just me talking, Victor Medeiros, not, I am I think the notion of, this, pressure, like like out migration, like people moving from the urbans to the suburbans, in mass, I think is a little bit premature, and only because I just read an article just the other day that basically all of the New Yorkers that went over to Vermont, during the height of the pandemic, and in the beginning loving Vermont, and the locals being somewhat frustrated by it. A lot of those folks now 6 months later are moving back because Woodstock, Vermont, for example, is beautiful, but there's really not much activity up in Vermont, year round, and so that's just it just goes to show there's a lot of variables that go into making real estate decisions, at the local level, and it's hard to predict. What I'll say is, again, when I look at the bigger picture, right? When I look at the demographic trends, when I look at the population trends in the Northeast, I think all signs do point to some potential pullback, but just when, it's still TBD. I don't have a good answer for you.
Great, thank you. I think we're probably at the limit here, Jen. 2:19. I think we had 2:15 stop time. So, anybody else have any other questions? And if not, I thank everyone very, very much, the presenters and the attendees. We look forward to being able to do this in person again someday when there's a return to normalcy, whenever that may be, which I hope is soon. I'm waiting. So thank you. With that, I guess it's up to me to sign off, and we'll do so. Thank you all very much.
Thank you,
Thank you.
guys.
Thank you, Frank.
Thanks for having us,
everybody. We
Frank.
appreciate it.
Thank you, everyone.
You bet. Bye-bye.